today's presentation, I believe whenever there's a challenge, we always find new opportunities. So in today's discussion, we're going to talk about a key update which was done in the 2024 federal budget, which is the increase in the capital gains inclusion rate. So I'm going to talk about specifically how it impacts small businesses. Before I go further in terms of the presentation, I want to highlight one major sector in Canada which has raised a concern. And that sector we're talking about is anybody guess? It's the healthcare sector, which is specifically we're talking about the medical professionals, which is the family physicians. Right. Before, when they wanted to increase the fees they could charge to the government, they were told that they can incorporate. By incorporating, they can save more money, hence they can have more funds for their retirement. However, with the new increase in the capital gains inclusion rate, that is going to have a significant impact on their retirement income. Now, how much that is going to be in terms of the dollar amounts, we will see that in the future slides. Now, another source of income which they potentially could have was the sale of business. So when you have a sale of business, generally talking about operating company, you can claim a lifetime capital gains exemption. For now, is 2024 proposed budget is about $1.25 million. Now, for those family physicians, the valuation of their practice have also gone down. The reason being is with shortage of family physicians, a new family physician can just set up shop. In a matter of few weeks, they will be overbooked. Right? So that retirement income source, which potentially they could have, is also not that valuable anymore. So just give you some context in terms of the healthcare sector. Even in the AI, in the technology sector, when they're talking about startup new businesses, going into AI innovation and so on, or the venture capitalists who wants to invest in businesses, even they have raised a lot of concerns concerning this. A quick disclaimer, any information we discuss today is going to be for educational purposes only, and we do not recommend to act upon any information that we have presented today. Definitely speak to your professional advisors before we act. A bit of information about myself. So I've been in the industry for close to about 14 years. In terms of the published work, I've been a major contributor in the writing of the fundamentals of tax course and the advanced tax course, which is offered by FP Canada Institute for their CFP and the QFP certifications. 4 key topics we'll be talking about. First is going to be basic corporate structure and taxation, how it works. I'll give you a very high level view of how it works. Then we talk about passive investment income rules. Third, we're going to talk about 2024 federal budget change for corporations. Specifically, we're talking about for small businesses, how the inclusion of or increase the capital gains inclusion rate is going to affect them. And then we're going to talk about some strategies to minimize the impact of the passive income. So first, we talk about operating company. So when you talk about these corporations and so on, this is an evolvement of a company, right? So generally a person, when they start off, they will generally set up as a sole proprietorship. Once they have some more income left over, then they will probably start to think about incorporation. So when you talk about operating corporation, operating company, this is where you have all the day-to-day activities. This is where you have the interaction of the suppliers, the customers, and so on. One of the benefits of setting up the operating company, of course, is the lifetime capital gains exemption. So as I mentioned, when you talk about the doctors, they have this, or any medical professionals or any setup and incorporation, when they go on to sell this potential feature in the business, they can claim that lifetime capital gains exemption. So that's one of the major benefits of it. Now, over time, as the company stabilizes in terms of growth and they have more revenue than expenses, they have maxed out in terms of reinvesting within their own company. Now they will look for other investment opportunities, right? If they're looking for other investment opportunities, that's where they will set up something called as a holding company. So holding, as the name suggests, it holds and manages assets. So that could be stocks, bonds, real estate, mutual funds, life insurance, right? So holding company. Now holding company, they have the potential to, just because you set up a holding company doesn't mean that now you can just flow money from operating company to holding company. There has to be a relation, right? There has to be a connection. So generally, if the holding company owns at least 10% of the operating company, 10% of the voting shares, the value of the company, Then they can flow through something called as an intercorporate dividend, which is tax-free. They can flow from OpCo to HoldCo. A lot of times I've seen business owners, they set up an OpCo, they set up a HoldCo, and they didn't create any linkage between the two. So then they didn't go through a lawyer. They just went through an accountant, and they never made that link. At this point of time, these are two separate entities. You can't just flow money through tax-free. There has to be a relation. Now, one of the questions which I get commonly asked is, should the HoldCo own 100% of the OpCo? That's a valid question. So the answer would be depends. What does it depend on? It depends on the OpCo opportunities. That could be one of the factors. For example, if you're talking about, let's say, an IT professional, and they are really the major source of revenue generation, the potential of sale of that business is very low. So would it matter of them to get a lifetime capital gains exemption? Probably not. I mean, if there's no buyer, how can you get a sale? So at that point of time, probably setting up 100% ownership of OpCo would make sense. If the OpCo has a potential for sale, right, they can actually sell their practice to somebody else. At that point of time, they can actually, it's usually recommended to own a certain percentage of the OpCo still individually. The reason being is only individuals can claim lifetime capital gains exemption. Holding companies cannot claim lifetime capital gains exemption, right? So it depends. In terms of some of the benefits of having a HoldCo, first is asset protection. So having a HoldCo, what you're really doing is any excess retained earnings, you're flowing it from OpCo to the HoldCo. Now, all the funds are in the HoldCo, which means any future financial or legal claims which happens to the OpCo is not going to affect the assets in the HoldCo. So it's acting as a shield. Next is in terms of estate planning. So Gary mentioned something about corporate freeze. Anybody knows what estate freeze is? Okay. For those who don't know, I'll give you a quick explanation. So let's say I own an operating company, and I have felt that I have enough assets to live off, and I want to give the potential growth of the company to, let's say, to my daughter, right? So at that point of time, we can do an estate freeze. So I can set up a HoldCo. So I can give my shares of the OpCo to the HoldCo, and in return, I will get preferred shares. So when I talk about preferred shares, I will have the option to get dividends. Let's say if whatever I thought failed, I will still have the option to get dividends. Also, I can even have voting rights. So even though I'm still not a common shareholder, I can have a majority voting rights, so I can still have control on the company. Right? So I can still have income, and I can still have control. Now, my daughter can go and get common shares of the HoldCo. So it means any potential sale from there on is going to be taxable to my daughter. So that's one of the benefits of setting up a HoldCo. You talk about tax savings, right? So if the HoldCo owns at least 10% of the OpCo, then more non-taxable money can flow from OpCo to the HoldCo. So of course, there's no taxes paid. You have more money to invest. Hence, you have other investment opportunities like investments, insurance, and so on. Then you look at tax deferral. If there was no HoldCo, and if the shareholders still want to do investments, what will they do? They will flow the money out from the OpCo to themselves, which means they will have to pay a personal tax. Having the HoldCo gives them the opportunity for them to decide when they want to be taxed. In certain years, when the business is doing well, they can opt not to take as much dividends or no dividends. In the years when the business is not doing so well, those years they can go and flow more dividends out from the HoldCo. So that gives them the opportunity to control the flow of tax being paid. This is a basic structure which happens. You talk about two shareholders, maybe you're talking about spouses, right? You have a shareholder one owns 50% shares of OpCo, shareholder two owns 50% of the OpCo as well. As the business evolves, as there is more money within the company as retained earnings, they can go and set up a structure as this, right? So instead of the OpCo individually owned, now the OpCo is being held by HoldCo. So this is where the business restructure happens. This is where you need to get the lawyers involved for this to happen. So shareholder one is holding 50% of HoldCo, 50% of shareholder two is holding 50% of HoldCo. Now, it looks good, right? But there's a problem. Can anybody tell me what's the problem? Absolutely, that's a good point. Because both of them can have different risk tolerance, time frame, investment preferences, right? If you have only one HoldCo, everything is happening within that. I mean, shareholder 1 could be 30 years old. Shareholder 2 could be 60 years old. Right? So there's a big difference in how they want to invest their money, when they want to take out dividends. Right? So you take it one step up, they can set up individual holdcos. Right? Now they own their own holdcos. However, at this point of time, they can also manage money based on how they want it to be. Right? In terms of CCPC, it can earn 2 types of income. One is active business income. So when I say active business income, it means that's where they create the goods, the services, and they exchange revenue, and they get revenue for it. In Canada, we do get, if you have an incorporated business, you do get taxed at a much lower tax rate. We are going to look at the example for federal taxes, how it actually works out. Passive investment income. This is actually being discouraged within the corporation. That's why they actually tax you at a much higher rate. Right? Because they don't want you to be setting up a company just for the purpose of doing investments. That is not really helping the Canadian economy for growth and so on. Right? So this is being taxed at a much higher tax rate. Here we take a look at the example of how it actually works. So let's say we talk from the top, we look at the operating company. So we have active business income. So the active business income is layered. So the first $500,000, so going from on that side, the first $500,000, you get taxed at something called a general corporate rate, which is the 38%. Now, because it's a CCPC, they do let you get the federal tax abatement of 10% and a small business deduction of 19%. So overall, on the first $500,000, for federal taxes, you're looking at roughly around 38 minus the 29, about 9% in taxes. Right? There might be some provincial taxes, 3 or 4%, depending on which province you live in. But federally, that's about 9%. Now, if there is any taxable income over $500,000, the general corporate rate is still the same, 38. The federal tax abatement is still the same at 10%. But if you notice, instead of the small business deduction of 19%, there's a general rate reduction of 13%. Right? So anything over $500,000 is getting taxed at about 15%. So it's still not bad. Right? First 500 is 9. Anything over 500 is 15. If you look at individual tax rates, you're looking at about 50% if you make more than $250,000 out in Ontario. Right, so it's still very good. When you talk about passive investment income, so the passive investment income, there is a tax. So the way they tax the passive investment income is they do it 2 ways. So there's something called a refundable tax, and there's a non-refundable tax. Right? We're going to take a look at the example in terms of how it is. But for example purposes, it's about 30.67%. It might not look big, but when you look at the example, you'll know exactly how it works. So we talked about retained earnings, right? They can reinvest back into the business. Generally, if you're looking at an operating company which is just starting up, any profits being earned, they will usually reinvest back into the business. And as long as they're seeing more growth in the business, they will just keep on reinvesting, right? Because the best thing you can do is bet on yourself, which is what they do. Now, over time, though, once they max out the returns they can get, right? There's a certain threshold you can reach. You can't just keep on generating excess revenue, right? You'll do more hiring and more goods and services, but you'll peak out on the returns. So there's going to come a time where you can put more money in, but you're not getting more returns. That's where they'll look at other opportunities. Then that's where they'll look at passive investments, right? So we talk about stocks, bonds, real estate. So passive investments owned by corporation, they are taxed at a much higher rate, generally about 50%. And if they were to go and liquidate those corporate investments, there's going to be a corporate tax bill. So as I mentioned, there's going to be a refundable tax. There's going to be a non-refundable tax. The refundable tax gets credited to something called as a RDTOH, refundable dividend tax on hand. At any point of time, if the corporation actually pays out a taxable dividend, only at that point of time, this refundable, you get funds out of this RDTOH account. So that's important. If you do not pay out a taxable dividend, you don't get anything back out. So how does it work? So let's say, as I mentioned, we have an operating company, have excess revenue, they set up a holdco, and holdco is doing investments. And now holdco, maybe they invested in some particular stock, let's say any dividend paying stock, and they earned some dividends, right? So any dividends being earned, there's going to be I'll just round up the number, there's a 50% tax on it. Out of the 50%, example purposes, let's say 30% is refundable, 20% is non-refundable. So that's 50% tax. If the corporation, as I mentioned, if they never pay out a taxable dividend, that money is sitting in the RDTOH account and it's just sitting there. You cannot unlock it. The only way you can unlock it if the corporation actually pays out a taxable dividend in the future. Right. So if the corporation pays out taxable dividends, it will trigger a tax refund, and then you can take money out from the RDTOH account. Another thing about investment income. So in Canada for corporate taxes, we have different sources of income, right? You have rent, you have interest income, net rental income, capital gains, and so on. The dividend income, any amount which just goes in as dividend income, money gets created into this RDTOH of 38.33%, but nothing is actually held back. In the event you pay out taxable dividend, you actually get a refund back. On interest income, net rental income, taxable portion of capital gains, you actually have money, you actually pay tax of about 20% on it. Right? So it is more beneficial for corporations if they are looking at investing purposes to actually have dividend income, because this actually can be unlocked the whole thing. Next is the CD account. So any point of time, business owners, the first question always comes up is, how do I take out money tax-free? Right? It's a very common question you'll get when you talk about corporate business owners as the first thing. Can you help me take money out? So a couple of things you can look at. You can look at one is something called the due to shareholder. So maybe they have put money into the company and now the corporation owes them money back. That's one of the easy way to look at if there is a line in their balance sheet due to shareholder. Next is CD account. That's the next one I will look at. So CD account is a capital dividend account. It's a notional account. So money which goes into this account is tax-free. Money which goes out from the account would also be tax-free. Right. So generally, how this account is going to be credited, generally there's three options. So before the proposed budget, it used to be 50% of the tax-free portion of the capital gains, less the capital losses. Of course, with the new inclusion rate, that is now dropped down to 33.3% if the budget goes through. Now the company itself can actually go and invest in other companies. Right? Those companies can pay them a capital dividend as well. So that's where the capital dividends received by the corporation could be. And last, of course, you talk about life insurance. So that's a very big piece. For life insurance policies, you're looking at death benefit minus the ACB. Right? So that's why when you're looking at corporate-owned life insurance policies, looking at the ACB is extremely important when you're looking at projecting in the future. Right? If you're looking at different carriers, you want to take a look at how that ACB plays out, because that is going to affect the CD account. Next, we'll look at in terms of some passive investment income rules. So there did some changes in 2019 where we talked about this small business deduction. What they really said is if the passive investment income earned within the corporation is more than $50,000, the passive income earned will actually affect how the active income is being taxed. So we'll take a look at one of the charts about how it gets affected. And they introduced a new concept, something called the adjusted aggregate investment income. So the proposal was for any kind of increase in the passive investment income, anything over $50,000, it will start affecting how much small business deduction they can get. So remember the small business deduction, we look at about 19%. So by the time the passive investment income is more than $150,000 odd, the amount of that small business deduction that they can get, which is getting taxed at 19%, is going to drop down to 0. So it means everything going forward is going to start getting taxed at the 15%, which is the federal tax rate. Right. So that's something you have to be aware of when you talk about business owners, to take a look at whether do actually have this problem. So one way to look at it is actually take a look at the corporate tax returns. Right. So if you look at the corporate T2 tax return, you look at page 4, line 417. If you see a number over there which is more than $50,000, then you know that you have an opportunity of talking about other alternate investment options, which is exempt life insurance. In terms of the impact, so we talk about $50,000 as being the threshold. So before, with the capital gains inclusion rate of 50%, if they had a capital gain of $100,000, then they will start getting, the active income will start getting impacted. Now with the new capital gains inclusion rate, if you look at the capital gain, is now they only need to have $75,000, and at that point of time starts affecting the active income. So instead of the 9% federal tax, they potentially, if the income is too high, over 150, it can start getting taxed at 15%. In terms of dollar amounts, so an example, so we're looking at federal tax only. Let's say the taxable active business income is $1 million. On the first $500,000, you see the whole taxes. Anything over 500, it's on there. So the total active business income is 120. The tax on active business income is $120,000. So it means you make $1 million, 120 is gone in taxes. Same scenario, but in this scenario, we're talking about passive investment income of 160. So over 150, you start if you notice, we don't have the small business deduction anymore. On both sides, we have the general rate reduction, right? On the same $1 million of taxable active business income, if they have $160,000 of passive investment income, you look at the tax on passive investment income 61, and the tax on active business income has jumped. How much has it jumped? About $30,000. That's just federal taxes. There's also provincial taxes. I'll talk a bit about associated corporations. So when you talk about access to the small business deduction, right, you have to know about associated corporations. I mean, you can set up an individual. For me, I can go and set up multiple corporations. But for me, the SBD, the small business deduction, is still the same amount. I can go and open multiple ones, but the effect is still the same. So there's something called as de jure control. De jure control means you actually own those shares. De facto control could be you don't own the shares, but you can influence. So for example, I can be the CEO of the company, and I can influence the board members to do what I want. I might not be a CEO, but I can still have influence on board of directors. Right? So I don't own, but I can influence. One of the association could be, we look at Corporation X owns 100% of Corporation Y, and Corporation Y in turn owns 50% of Corporation Z. So in this one, all the three corporations, they are associated. And to determine the association, the threshold is usually about 25%. Right? So if you own 25% or more of that particular company, it is going to be considered as an associated corporations. So this is a good one, where you talk about two spouses. Maybe you are talking about somebody who's a medical professional, somebody's in IT, right? So Mr. A owns 51% of their Corporation A and owns 49% of Corporation B. And in turns, Mr. B owns 49% of Corporation A and 51% of Corporation B. Right? So this is where the association comes into play. Next, we'll look at in terms of the 2024 federal budget. So on or after June 25th, 2024, this is the proposal, which is the capital gains inclusion rate is going to be increased to 66.67% from 50%. What the impact is, of course, right off the bat, we know there is going to be more taxes to be paid on sale of the business or sale of the assets, right? So that we're looking at in the future. But it can also affect something called the adjusted aggregate investment income, which is the passive investment income we talked about. Right? So during the lifetime of the company, while they are operating the business, it can also affect it. So again, if there's more taxes to be paid, you're paying more taxes on active business income. Pay more taxes means you have lower investment income to reinvest and available for shareholders for distribution. We'll take an example. So we look at old rules versus new rules. So let's look at the old rules first. We're looking at, let's say the company has a fair market value asset of $1 million. ACB is 0. Capital gain is $1 million. Taxable capital gain, non-taxable 50% each. So it's $500,000 each. For proposed new rules, same stuff. However, if you look at the taxable capital gain has jumped from 500 to about 666. So about a jump up of about $166,000. But the main factor is the CDA. I talked about the free money which they can potentially take out from the corporation. That has significantly been reduced. Before it was 500, now it's dropped to 333, which is about $170,000 odd. We go into the next slide. So the old rules, the taxable investment income is $500,000. So the taxes, so we're looking at the Ontario, right? So this is based on Ontario tax rates. So tax on investment income is about 50.17. So passive investment income is getting about 50%. If you notice, I split the two taxes between refundable tax and non-refundable tax, right? So refundable tax is something you can get back in the event the corporation pays out a taxable dividend. The non-refundable tax, that money is gone, just as good as gone. You don't get it back. In terms of the fair market value, again, you start over $1 million. Tax on investment income is $250,000. The after-tax corporate investment income is about $749,000. For the proposed new rules, the tax on investment income has gone up, right? It's gone up about $83,000 odd. If you look at the bottom line, which is the last line, that is crucial in terms of what is actually left within the corporation, right? So old rules was $749,000. New rules or proposed new rules is $665,000. So the difference is about $83,000 odd. Now the question is, as a shareholder, you still don't get access to the money yet, because the money still has to be paid out to you. So that means there's another layer of tax. And this is where another layer of tax happens. Right. So again, you're looking at capital dividends, which is the amount which can be flown tax-free. Old rules was $500,000. We look at taxable dividend of $249,000. We make the assumption that whatever the money was stuck in the RDTOH, we actually are recouping all the RDTOH back, which is the $153,000. And we are making the assumption that, hey, you know what, the total taxable dividend, we are actually paying it out. And again, we're looking at the Ontario tax rates. So the tax on dividends is about $192,000, net taxable dividend $210,000. Now the net amount to shareholder, which is the CDA plus the net taxable dividend, is about $710,000. With the proposed new rules, same calculations, different numbers. The net amount has gone down to $613,000. Right. So now if you look at before, at the corporation level, you're looking at an $83,000 difference. Now when you look at a shareholder level, because eventually money has to pay out, it's almost $100,000, $96,000, $97,000. So it's a big impact, right? This is just on $1 million. If you're talking about medical professionals and so on, they have multiple $1 million in there. Or you're talking about real estate holdings and so on. Strategies to minimize the impact of passive income. The basic one you're looking at is the compensation. So of course, if they pay themselves out, then there's less money to reinvest, hence they won't have this problem. The one benefit of compensation is they can contribute to the CPP. Personal investments, I mean, when they draw money out, they can invest in RSP, TFSAs, and so on. This is where asset insurance advisors or financial planners come into play, which is acquiring an exempt life insurance policies with cash values, corporately owned. And there's the EHP, which is we have the critical illness insurance for business owners. That is another option for them as well. Okay. So at Desjardins, we do have a lot of sales concepts on the personal side and the business side. Because you're talking about on the business owners, we have the corporate wealth escalator plan, compares money invested in the non-taxable investment versus cash values. We have the executive health plan, which is a critical illness for business owners. I'll show you a bit about corporate income tax optimizer. I think for today's topic, that is going to be a relevant sales concept to look at. And we have the corporate insured retirement plan, which I think most of you would be well aware of, yes. One thing I want to talk about EHP, right? In terms of how are we different from other carriers or so on, right? When we look at the split dollar arrangement, we're talking about corporation pays X amount of dollars, and then the shareholder will pay Y amount of dollars. The challenge always is if the CRA comes back and asks, how is this money being paid out is not a shareholder benefit? How? Right? That's a very viable question, because I mean, the company is paying for an insurance, which, I mean, can you justify it? Right? So in this example, we are looking at an EHP, and we're looking at the company paying about $5,175. So that's going to be questioned. The company paid premium. How is it not a shareholder benefit? So with us at Desjardins, it's very easy. What we look at, if the company did not enter into an EHP contract, and if they just entered into a regular contract for the key person of the shareholder, the cost of the premium is exactly the same. They're not doing any benefit to the shareholder. They're buying the insurance to cover the risk for the company. Right? They are not paying any cent more than required, which means it's not a shareholder benefit. But at this point of time, though, if you look at so we have corporation paying money, we have shareholder paying money, right? The question is, we're not talking about the shareholders. The shareholders paying money from after taxes. right? So that is already taxed anyways. The question comes down to is the corporate money though. Are they doing a benefit to them? Using this, we can easily tell them, you know what, if the company did not even enter into the contract and they still wanted the shareholder to be covered for risk because the shareholder is important to the company and so on, they're not paying anything extra. They're paying exactly what is required based on the illustrations. Right? Because going forward, I mean, it is being the split dollar arrangement, it is being something which is being looked into, right? And if you're talking about individuals who are buying a larger EHP policies, I mean, right now I'm showing 5,000. Sometimes it could be $20,000, $30,000, $40,000. And if you do it over 10, 15, 20 years, that could be a lot of money, right? You don't want the CRA to come knocking at that point of time, and then your client says, hey, you told me this was all going to come out as tax non-taxable. How come they're asking this is a shareholder benefit, now I have to pay taxes on it? All right, so that's a very big piece about the EHP which we offer. If you guys have access to the illustration system, you can easily justify it as well. If you have an accountant asking you a question, you can easily display this and show them why it is. You can, if the corporation doesn't need the insurance policy anymore, at that point of time, the shareholder can get the health benefits, the combination of these two back. So I think right now we're looking at about 100% after 15 years. So if the company says we don't need this person to have coverage on this individual shareholder anymore, at that point of time, whatever they paid over the span of 15 years, so let's say this person is 50 years old, you will get these two times 15 back, right? So what's happening is instead of them self-insuring themselves, I mean, they can go and put this $2,000 and invest it themselves, and the company can also go and invest it by themselves. But keep in mind, when they invest it in the future, we're looking at capital gains problem in the future. At this point of time, they're not self-insuring, they're transferring the risk onto the insurance company, which means at this point of time, the money is, I mean, for $7,000 odd, looking at a coverage of $500,000. And in the future, as I mentioned, if the company says we don't need the insurance anymore, guess what? You can get all of this money back. So because we're talking about active income, passive income, we're talking about the capital gains and so on. So last year, we developed something called the Corporate Income Tax Optimizer. So this one really shows you if you have an actual client's portfolio, you can put in whatever investments portfolio they have. Depending on what investments they have, you can actually customize it as well. If you have a conservative portfolio, moderate, or if you want to do a different rate of return, you can do that. And then, of course, the passive income. So you can input the passive investment income which they're putting in. And these charts will always keep on changing depending on what you put in. So this is the input screen which we have. Now, when you're proposing a life insurance or if you're proposing an EHP, right, you have to, if you have somebody who is more tax focused, this is where you can actually input those information and see how much tax savings they can actually get. Right? So in this example, I've shown you have 20-pay shareholder 1, 20-pay shareholder 2, and we're talking about EHPs in both individuals. So this is where we can see that, you know what, before, whatever they did without the insurance policies was on the left-hand side. On the right-hand side is after they have used the policies that you have mentioned, how much tax savings they can potentially have. And of course, if you want to access to our sales concepts, you can definitely scan the QR code, and this will take you directly to all our sales concepts. Okay, so you guys can definitely take some time to look at everything that we have to offer on the personal side, on the corporate side. If you get to need more information about how to use it, definitely reach out to your own RSDs. They'll be more than happy to help you guys out. Thank you.